welcome to this class. In the last class we were looking at Dooms loop. What happens for a firm when it gets caught in a Dooms loop and how it finds itself difficult to extricate from the doom loop. So, just getting you back to that figure. So, the firm tries to cut prices to hold on to market share. What does the competitor do? The competitor matches the price of the firm and still is profitable. Then the competitors start innovating and develop better product at lower cost. What is going to happen? Competitor gains market share at the firm's expense. What is the result of all this on the employees of the firm and the firm itself? Firm has inadequate margins to readjust. Then what happens? The quality of the product suffers, the services also suffer. Then the employees become demoralized. This is how when a firm gets caught in the Dooms loop, it has a chain reaction running throughout the firm. This is where this is an important part of business strategy for a firm to be very cautious and not get caught into this Dooms loop. And in order not to get caught into this Dooms loop, what could be the type of precautions or the proactive strategies that the firm should adopt is the company should always be having an evaluation of its business strategies. That is, it should be a continuous evaluation of business strategies. It should be constantly trying to innovate, phase out old products and introduce new products into the marketplace. So, the company should be willing to a certain extent experiment with the characteristics of the product in order to see that the product offering it puts out into the market is differentiated from the competitors, so that it can stay in business. So, this is the most important characteristic which the firm has to follow. Suppose it does not do it on for a long time, let us say it keeps on going. Long time in the market depends on the type of product and the product life cycle that comes or gets attached to that particular product. An electronic product might be having a shorter life cycle, a consumer durable may be having a slightly longer life cycle, depends on the type of the product. But it is for the firm to innovate, to constantly innovate, phase out old products, come out with new products. If you do not do that, or if the firm does not do it, then there is a very good chance that it might get caught in the present day competitive market in this Dooms loop. And if it gets caught in this Dooms loop, it may find itself difficult to extricate, because this is a self reinforcing process. It can drive an organization to cyclical situations from which it finds difficult to extricate itself or get out of this whole scenario, extract itself. So, it is constantly required for the firm to upgrade the products, services and efficiency of the distribution channels. Now, we have looked at this Dooms loop, how it can get an organization into this cyclical situation where it finds difficult to extricate itself. And we have also suggested what can be done by the organization not to get itself into this type of a situation. What does it mean? It just means that for an organization, it is always required to have a continuous evaluation of business strategy for all the business units of the company. It is a continuous process. It is not that you can just say, I did the business strategy for this, I will revisit it again after the next quarter. No, it has to be an ongoing process. Many times you have to keep on watching it continuously as to what is happening in the market, so that if corrections are required within the quarter itself, you should be able to do it. This is what the competition in the market is driving firms towards, and that is where strategy and strategic management is becoming more and more important. Now, why are we interested in the business strategy? We are interested in the business strategy because every firm has got number of business units. These firms, these business units can be strategic business units, and the corporate strategy that you are drawing is for the entire firm as a whole. So, in order to draw the corporate strategy for the entire firm or the entire organization, you require to be clear about the business strategies of every business unit or every strategic business unit. So, this is where the whole crux of the problem comes. So, this is where the corporate planners, now strategic planners, have to think very hard before drawing up a strategy. This is called a strategy map, mapping the strategy of a business unit. Many times they require to draw what is called the strategy roadmap. What is the roadmap of strategy for the business unit for the next few quarters? So, all this has to be presented. We will look at that a little more in detail when we go along in the next few classes. So, all these business strategies are required to drop, as I said, the corporate strategy. What are the important issues that are involved in corporate strategy? So, if you look at the type of issues that are involved in the corporate strategy, so this is what we are likely to have in the corporate strategy is something like this. The company's orientation towards growth, stability or retrenchment. This is referred to as directional strategy. What is the company's policy? Some policy issues are involved. What is the orientation of the company towards growth, stability or retrenchment? Referred to as directional strategy. Then the second one which the company has to think about is the markets in which the company competes through its products or business units, referred to as portfolio strategy. The activity, the third issue that becomes important is the activity coordination and transfer of resources for achieving capabilities among product lines and business units. This is referred to as parenting strategy. The second and third points, that is the markets in which the company competes through its products or business units, and then this parenting strategy. We will discuss this in more detail when we consider what is called the portfolio, when we discuss the portfolios or the portfolio matrices. These are called, actually, if you really look at it, the portfolio analysis. The whole system comes under the category of portfolio analysis and display matrices. The portfolio analysis, we are looking at corporate investments in different products or industries, SBUs. Then we do a balancing of the portfolios. The balancing of the portfolios is done with respect to net cash flow, the state of development and the risk that is involved. We will be discussing several display matrices which can help in portfolio analysis. We discussed all these issues with respect to the business strategy. We discussed these some of the main issues with respect to the corporate strategy. And why did we do this? We tried to bring out the type of advantages which the businesses in India tend to assume are there because of the lower labor cost. May not really be there. This is what was really brought out in the whole this thing. So, many of these labor cost advantages the firms might be losing due to the different types of duties which may be charged or which are charged by the government depending on the sectors concerned. So, this brings you to one important thing with respect to the firm. Looking at this type of environment, firms themselves have to think what is the type of relative cost advantage they can get and what is the type of competitive strategy they can drop in the present scenario in the Indian market. So, if I give here two examples. One example is that of Modi Tyres. Initially entered the largest product segment, that is truck, with latest technology and lower prices. The strategy that was adopted was good value for money. What did it do? It subsequently matched the market leader's price and displaced him by capturing higher market share. So, this is the way a corporate strategy of the firm got redrawn after the market entry. Similarly, these Hero Cycles dropped irrelevant product attributes, subcontracted production of parts to have a good market share in the cycles market. So, if you really see in the present day also market situation also, this Hero Cycles enjoying very good strategy. So, in other words, this brings you to very good competitive advantage. This strategy brings you to the question of what is the type of strategies the firms should adopt when these types of situations crop up. So, in other words, what is the type of diversifications that one can go in for. So, I take you to two types of diversifications. The diversification strategies can be vertical and horizontal growth strategies, which can help the firm. The two basic diversification strategies are one which can be concentric, that is related to the industry in which the parent operates. That is, if you are operating in a tire industry, let us say, the related industry is again with respect to tires. You do not want to go away from the tire business. This is when this is not an appropriate strategy. That is, when this concentric or related diversification is not an appropriate strategy. This is dealt with in detail in my book. You can refer to chapter 7 in greater detail, just reading out a few points from there. Concentric or related diversification refers to growth into a related industry. This is not an appropriate strategy when the firm has a strong competitive position, but industry attractiveness is low. Note that this is not an appropriate strategy when the firm has a strong competitive position, but industry attractiveness is low. This type of diversification looks for synergy in relation to technology, customer usage, logistics, skills and product similarity. Related diversification can take place through internal or external means. Similarly, unrelated diversification, when the firm realizes that the current industry is unattractive or it does not have the abilities or skills which could be easily transferred to other industries, it employs the conglomerate diversification strategy. It diversifies into unrelated products or market lines. What is the firm mainly concerned with here? Cash flow considerations and reduction of risk. So, this is the way a firm goes through different strategy changes or different strategy responses. This chapter also gives you a few more strategies. Which I am just reading out. One of them could be exporting, that is where you ship goods from the home countries to other countries. The warehouse in Bangalore could be a good example, produces ready-made garments for export in developed countries, exporting to developed countries. Then there could be a licensing agreement where a firm grants rights to another firm to produce or sell its products in the host country. In return, the licensee pays compensation to the licensing firm for the technical expertise. Can be a useful strategy when the licensing brand is well known. If you look at, if you take the defense sector, the Sukhoi fighter planes are produced in HAL under a licensing agreement. Then joint ventures could be another option. strategic option, that is where formulation of a new company which combines the resources and the expertise in relation to product and technology available in different companies. Companies could also look at acquisition, can be a relatively easier way to enter the international market, refers to a firm buying out a firm already operating in the market. So, Maytag in US acquired Hoover. Turnkey operations could be one more strategy, refers to contract for construction of operating facilities in exchange for a fee. The facilities may be transferred to the host country when they are complete. So, Tata Consulting Engineers is in this business. The BOT, that is a build, operate, transfer, is a variation of the turnkey operation. Many infrastructure projects are taken up through this route. The Bangalore-Mysore infrastructure corridor project is to be operated on the build, own, operate, transfer, that is the boot concept. So, a double O coming in. Then you can also go in for what is called a turnaround strategy. What does the turnaround strategy do? It lays emphasis on the improvement of efficiency, and it is appropriate when the company is facing problems. So, it involves two steps. One is construction, that is effort to stop the bleeding of the firm. Then consolidation is where you implement a stabilizing program. So, many of the PSUs have gone in for turnaround strategies in India also. So, some of the private companies have also gone in, like Sylvania Lakshman is one example. So, all this similarly the you can cite different examples both from the public sector and the private sector of turnaround. I give you here one very important example of a private sector turnaround. This is, I am reading it from my book. This is the turnaround strategy adopted by IBM. During the 70s and 80s, IBM dominated the computer industry worldwide. It was the market leader in both large mainframes and small personal computers. Along with Apple, IBM set the standards for all personal computers. Even now, when IBM no longer dominates the field, personal computers are still identified as being either Apple or IBM style PCs. IBM's problems came to a head in the 90s with the computer sales falling. More companies were choosing to replace their large expensive mainframes with personal computers, but they were not buying the PCs from IBM. An increasing number of firms like Hewlett Packard, Dell, Gateway and Compaq had entered the industry. They offered IBM type PC clones that were considerably cheaper and more advanced than the IBM PCs. IBM's falling revenues meant corporate losses in 1992 and 1993. industry experts perceived the company as a bureaucratic dinosaur that could no longer adapt to changes. Its stock price fell to $40 with no end in sight. IBM's board of directors hired a new CEO, Louis Gerstner, to lead a corporate turnaround strategy at Big Blue. The nickname IBM earned from its rigid dress code policies. To stop the flow of red ink, the company held its long held no layoffs policy by reducing its workforce by 40%. Under Gerstner, IBM reorganized its sales force around specific industries such as retailing and banking. Decision making was made easier. Previously, according to Joseph Formicelli, a top executive with the PC division, he had to go through 7 layers to get things done. Firing incompetent employees could take a year, so you pawned them off on another group. Strategy presentations were hashed over so many times, they got watered down to nothing. Under Gerstner, however, formal presentations were no longer required. The emphasis shifted to quicker decision making and a stronger customer orientation. In 1987, customers had been forced to wait for 5 to 7 years for a new mainframe series. Now IBM produces a new line almost every year. Gerstner personally talks with at least one customer every day. The company's PC business, which had market share and had generated huge losses in 90s, has become profitable. Its market share rose almost 1 point to 8.9% in 96, second place in global market share. Its stock price topped $140 by end 96. Customers are pleased with the company's customer service. Over the last couple of years, they have been going out of their way to have a contact person you could call with any issue, reported Linda Virsema, Chief Information Officer at LTV Steel Unit, part of the LTV Corporation. The corporation has still a long way to go to complete its turnaround. Even though the revenue increased by 40% over the past decade, profits increased only by 3.2%. In 96, IBM's revenue increased by just 5.6% compared to 19% at HP and 29% at Intel. According to the Chief Financial Officer Richard Thorman, we have done a lot, but still have a lot to do. So now the position is IBM has really turned around and has been able to hold on or to its market niche very well. So this is the way the different strategies work. Now when it is impossible for a firm to hold on in this competitive marketplace, the last resort that it does or it goes in for is to divest. To divest, that is divest the operations of the firm. It can be through selling the firm itself or going in for liquidation. these are called these are essentially strategies which are adopted by firms when they are in a weak competitive position. They virtually find no way out. They do not see any way out at all of the situation in which they are in the marketplace. So, this is the reason why I mentioned to you that a company should always be on its toes in the present competitive scenario, try to avoid getting into doom loops, and when it gets into a doom loop for a company, it finds itself difficult to extricate from that scenario or extract itself from that position. So, this being the case, this may drive the company towards this desperate situation of selling the company or liquidating the assets, divesting many products, product lines, things like that, which also happens in a competitive market. So, these are basically these are strategies which are followed by firms with a weak competitive position, that is when they are unable to pull up their bootstraps. If a firm has multiple product lines, it can divest the product line which is not profitable. But many times, suppose it is the company does not have too many product lines, then dropping product lines also becomes a big question mark for the firm. Bankruptcy refers to giving up of the management of the firm to courts in return for the settlement of the company's obligations. So, you saw in the recent economic crisis many of the US firms doing this type of last ditch resort or last ditch law. This is a last strategy which a firm can adopt, that is going out of business. So, you saw many of the giants of the American firms like Morgan and Stanley pulling the curtains, applying for bankruptcy. Then liquidation refers to termination of the firm because the industry is unattractive. What is the benefit of liquidation over bankruptcy? The benefit is that the BOD with the top management makes the decision instead of turning them over to the court. So, the BOD still makes the decision. Now, in order to have a good portfolio, why are we looking at all these strategies? We are looking at all these strategies so that the company can have a good portfolio analysis or a balancing of portfolios is possible. So, as I mentioned to you, three important things with respect to balancing. One is with respect to net cash flow, second is with respect to the state of development, and third is with respect to the risk that is involved. So, this becomes extremely crucial. So, what is meant by this net cash flow? Just explaining a few points from my book. A company may have different businesses behaving differently in terms of their cash flow. A growing new business, though profitable, may also require additional cash investments. A mature business, on the other hand, though less profitable, may not require such investment. it has to balance different businesses so that there is an overall cash flow position with the desired financial strategy and condition of the company. In other words, for every business you draw a business life cycle. At what life cycle is that business in? Is the business in the growth stage, or is the business in the introduction stage, or is it in the maturity stage, or is it in the decline stage? Note that a business unit may have number of products or product lines. One is that of drawing a PLC for a particular product, the other is that of drawing the PLC for the business itself. The third is that of drawing the PLCs for all the different business units concerned, which the firm has, and the last stage or the fourth stage is that of drawing the PLC for the firm itself. How does it look like? But the assumption is that the firm is going to be a continuous entity. A business unit might go, but the firm will remain. So, keeping that in mind, a firm's existence is drawn up. That is how the corporate planners or the strategic planners exert themselves to do this. Now, this brings you to the state of development. Businesses or products are likely to go through different life cycle phases such as embryonic development, growth, maturity and decline. A company cannot depend on one product line. When it comes to the decline stage, it may be too late to start on a new product. For a company to have stability, it is necessary to match the different businesses at different stages in their life cycles to achieve immortality. The objective is, while the individual business units grow, mature and decline, the companies should continue to grow. That is what I just mentioned. You expect the company to have a continuous existence. You do not expect the company to come down, but some of the under greatly unforeseen circumstances, like what happened a few years back in the US market, a company might come down, unheard of, not usually the case. Risk is a corporate portfolio should aim at reducing the risk of a critical financial setback. This may be achieved by putting together diverse business activities with different or even opposing market forces. A solution may be to diversify internationally because of the different market and economic forces, resulting in different cycles of development, growth and decline. Opposing exchange rate movements also can produce the same effect. Businesses with different seasonal sales cycles may be combined to ensure a more stable domestic market, though it is possible that the macroeconomic trends at national levels affect all business sectors. So, in other words, risk, this ability to predict risk is becoming very important now. This is where the planners or the strategic business unit is putting all its energies, it is putting all its efforts. Suppose there is an investment which a company wants to make. the risk analysis group comes into focus. It advises the company whether it is worthwhile to get into this investment at all. So, many of the large companies, if you really see almost all the software majors in India, they have this risk analysis group. This risk analysis group continuously advises the top management on their major investments, sometimes even minor investments, which investments they have to come out of all these types of things. So, these are this is a very important area of strategic management, and all this comes under this portfolio balancing. So, this portfolio balancing forms an important section of strategic management. And in order to do this portfolio balancing, these three things, that is the net cash flow, the state of development and the risk, they have to be considered predominantly. They become vital inputs before we can say this is the type of strategy that we are going to adopt. In order to help the firm in this balancing, the firm makes use of different matrices for portfolios. These are called portfolio matrices. What does the portfolio matrix do? It tries to map the business units of the firm according to where they stand in the market at a particular point of time. So, it can be with respect to the state of development, or it can be with respect to the relative market share. When we say relative market share with respect to the leader. So, where do you stand with respect to the D leader, or it can be with respect to the relative market growth rate. Suppose a company is operating in a business unit is operating in a market growth rate which is less than the average, then the company strategies has to be different. So, the portfolio matrices help the company to map the business units properly. So, this is where the whole question comes. How do you map these business units? So, this mapping the business units is facilitated by drawing the portfolios. Now, why do you want to map the business units? You want to map the business units so that you can take the most appropriate portfolio balancing, which is good for the firm or in the interest of the firm. So, this is where we are interested. So, some of the matrices which can be of interest or which we will consider in the next class on in this portfolio are these 5. That is one is the BCG matrix, that is the Boston Consulting Group matrix. The second is the McKinsey matrix. The third is the Strategic Planning Institute's matrix, or it is also called the Profit Impact of Market Strategy, that is PIMS. And the fourth is the Arthur D. Little Companies matrix. Then the fifth is the Hofer's Product / Market Evaluation matrix. So, this is where we are going to consider some of these matrices. So, as I mentioned, why are we interested in this portfolio analysis? We are interested to allocate resources for best total revenue. So, in fact, many of the Fortune 500 company, most of the Fortune 500 companies, if you really look at them world over, they make use of these display matrices for portfolio balancing. So, from that angle, all these display matrices become extremely important, and every company should be able to map their business units in with respect to these matrices and take that matrix which is appropriate to the firm. So, we will stop here. We will take up each of these matrices one by one in the next class. So, thank you.